Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a video update on Friday, August 18th, 2023. As my colleague John Pearce observed in his daily commentary this morning, the stock market rally has hit a brick wall. A combination of subdued guidance by many companies for the second half of this year and hawkish monetary policy language from the Fed have put Wall Street in a risk-off mode. Since breaking above 4,600 the last week of July, the S&P 500 index fell below 4,400 this week. And here's a chart of the S&P 500 year to date. And you can see all the way up until really the end of July, it was on a clearly upward trajectory. But over the past month, and I'm going to shorten this out to 1 month just to show you, that doesn't really help much. But you can see here from its peak in July, clearly a shift in direction. That's not a big drop, but it clearly signals a change in momentum for the stock market. With the 10-year Treasury note now yielding 4.2%, some institutional investors are cashing in their stock market gains and putting that money in bonds. And by the way, here's the 10-year Treasury note yield, and you can see it was around 3.5% back in March, April after the collapse of Silicon Valley Bank, then leveled off around 3.7 to 3.75. But again, since the third week of July, clearly an upward trend in rates, got as high as 4.3% yesterday, but definitely no longer in that zone that it was in earlier. And at this point, the risk premium for remaining in stocks is not sufficient to justify keeping that money in the stock market. That does not necessarily mean that a stock market correction is certain. However, it does mean that the narrative surrounding equity values and the economy needs to change before stocks can go much higher. And right now, that narrative consists of higher energy prices, declining consumer spending, and China's weakening economy. And right now, here's the PCE price index, which is the personal consumption, income and outlays. And if you look at the bottom line here, PCE excluding food and energy in February is 4.7, March 4.6, April 4.6, May 4.6, June 4.1. Clearly a downward trend. Haven't seen the July numbers yet, but may break below 4%. A month ago, I noted that the global financial markets were in a state of equilibrium with oil prices around $70 a barrel, the price of gold near $2,000 an ounce, and the yield on the 10-year Treasury note at 3.75%. That equilibrium is no longer in place. Oil is now over $80 a barrel. Here's a chart of oil, and you can see again back in June, it was under 70, steady climb up. Got up around $85 a barrel last week and is now bouncing around between 80 and 85. Gold is closer to $1,900 an ounce, and here's gold, again, peaking up around $2,000 back in March, April. Downward trend, and you can see during the last month, went from being above $1,950 to closer to $1,900. And as I noted earlier, the 10-year Treasury note yield is now above 4%. Today, you can see right here as I'm speaking, 4.255. For the following reasons, I do not expect to see the stock market resume its upward momentum until those metrics get back in equilibrium. High energy prices are a net drag on the economy. Lower gold prices mean the dollar is weakening, which equates to less purchasing power for American consumers. And bond yields need to drop to entice institutional investors back into the stock market. None of those conditions are permanent, and all of them will eventually change. However, I do not expect any of them to change quickly, barring a major macroeconomic or geopolitical event. In short, I expect more of the same for at least the next few months. That is not to say that there will be nothing for investors to do until the logjam is broken. Prices of individual stocks will fluctuate, providing an opportunity to open new positions at favorable long-term entry points. As William Ward observed, the pessimist complains about the wind, the optimist expects it to change, the realist adjusts the sails. That's this week's PF Video Update, and I look forward to talking to you next week. Thank you.